Hey everyone, welcome. My name's Gary Taylor. Thanks for taking time to check out this video. I appreciate it and I think you'll get a lot out of it. This video is on mastering leveraged ETF trading. Now, that's saying a lot, and frankly, I don't think that's ever going to be possible. But I think it's a reasonable goal to go for. So that's what we're going to be talking about here. I've been watching a lot of videos on YouTube over the years on leveraged ETFs. And frankly, most of them were focused on the viability of trading in the first place. Do they make sense to trade? Are they too risky to trade? Are leveraged ETFs a reasonable investment? And frankly, there is a tremendous amount of risk involved with trading leveraged ETFs. However, I think there are some really good strategies available to use to trade them. Most of the videos, like I said, have been focused on the viability, but there have been some that delved into strategies for trading leveraged ETFs. And I would like to present to you a little bit of an overview of the ones I thought were the best ones available on YouTube anyway, for putting you on the path towards mastering leveraged ETF trading. I want to start out with making it clear that this video is for entertainment and educational purposes. I'm not a licensed financial advisor. Trading leveraged ETFs is extremely risky, and I'd appreciate if you take just a couple minutes to review the items on this disclaimer because they are important. And with that, I will get into the presentation. So this is not meant to be a comparative study of different leveraged ETF strategies. This is more of an overview. And the reason I say that is that there's probably no particular strategy that's the best for everybody. Everyone has different trading and investing styles. Everyone has different risk tolerances. And, one strategy is good for one person and may not be good for another. So, keep that in mind as you view these different strategies. And what I'm hoping is that you'll come away with this after viewing some of these and go, oh, there's one that looks really interesting that I want to learn more about, and give you an opportunity to do some research, find out more about it, and see if it's one that really fits with your trading style. So the takeaway is hopefully you'll go and do some more research and find something that's going to be very helpful to you. Now, that said, I think I want to touch on strategies for just a second, in that a strategy is not the same thing as a trading indicator. Indicators are things like moving averages, MACDs, etc., that tell you when something is happening. But a strategy is based on a set of rules. Those rules define when a buy will take place, when a sell will take place. They're meant to provide you with some form of risk mitigation, and they are, or should be, developed around a set of rules that have a clear definition. Now, you need to be able to determine that, yeah, this is a good set of rules and that the strategy is good. And the only way to really do that is with back testing. So that is the way that most financial folks would evaluate a strategy, is through back testing. And that tells a story as to how good the rule set is and how good the strategy is, because you can at least look at how a particular strategy worked in the past during a past market environment to figure out that, yeah, comparatively anyway, it did well against, let's say, buy and hold, or did well against another strategy. Now, that said, too, Some of these will have results, backtest results that may look very enticing. They may look, terrific, but take it with a grain of salt because, we're talking about the past versus what something is going to do in the future, and there's no telling what's going to happen in the future for sure. So, so with that said, I'm going to move on to the next slide and tell you that we're going to be talking about buy and hold, not so much as a strategy, but as a methodology. And we're going to touch on swing trading, actually, a couple of different versions of swing trading. One that's used by a lot of traders today, it's fairly popular, and it's considered a bit of a high probability type of trade. And a version of that that I call a combination swing trade and then touch on day trading and how to use day trading for trading leveraged ETFs. Last, I'm going to introduce you to a new strategy, at least new to the public, called the LETF Leveraged Edge Strategy. Now, this one has actually been in the works for about 3 or 4 years. And in that sense, it's not really new, but it's been in development that long. It's been in a beta test mode for the past year with roughly 100 users working on it and providing feedback to help improve the strategy. So that's going to be the last one I'm going to touch on. And I've been personally involved with that the past few years, and it's been a lot of fun. And so I'm excited to talk about that. So buy and hold uh, is very difficult when it comes to leverage ETFs. It's near impossible, I think, to just buy and hold leverage ETFs, and I'll show you why in a few minutes. But let's say that we did do a buy and hold approach. If we did that, there really wouldn't be any monitoring involved. We could simply buy, and for that matter, there's no timing required from the standpoint of entries and exits. But we'd simply buy and sell when we felt it was time to sell, and hopefully make a profit. Uh, there's very little work that goes into it. It's not really a strategy, though. It's just really an investing method. And if you try to do this, I think often you'll find that people invest based on emotions. Uh, Emotional buying and selling can be really tough on a portfolio, and the emotions can range from ecstatic to, uh, devastating or gut wrenching. There's a wide range that you'll probably experience, but that's what tends to happen with buy and hold type methodology, I believe, anyway. Let me explain that in a little bit more detail with looking at the numbers here. And if we look at these are all calculated based on individual year. So if we look at, let's say, buy and hold for the TQQQ on the left, this is an 11-year study for 2014. That was the year end 2014. So the numbers to the right of that are based on buying at the very beginning of that year of 2014 and then selling at the very end. In that particular case, 2014 did about a 63% return and had a max drawdown of 13.8%. You'll find that there were some very good, profitable years in here in this 11-year period. Unfortunately, there was a few really devastating years too. 2018 and 2022 were killer years as far as your portfolio. They would have done some real damage. And if you look at the drawdown involved for both those years, 38% in 2018 and 81% in 2022, I'm not sure anybody could really sit through those kind of drawdowns. That's tough to do. The interesting thing I'd like to point out to you too, though, is that even in good years, such as 2020 here, where the strategy, where buy and hold had 106% return, there was a 60% drawdown, over 60%. So you're likely to experience some pretty heavy drawdowns working with leveraged ETFs in general. It's fairly common. You'll find that the SOXL has similar type numbers. The profitability was very good. Unfortunately, in their case, there was 3 really bad years. SOXL is quite a bit more volatile than TQQQ. These are both very liquid, very popular leveraged ETFs. So that I think is an important aspect of trading a leverage ETF is you want one that is liquid, that is very easy to get into and out of, and not one that has a small number of shares that could hurt you as you try to exit it because you can't get out right away. The interesting thing on SOXL was this 91.6% max drawdown over the 11-year period. Again, a number that I know I could not handle, and I'm sure most traders couldn't. So let's look at the first strategy, which is swing trading. Swing trading is, I believe, more of a high probability strategy. It uses a stop loss, and often you'll place profit targets. You'll typically use a combination of daily and weekly charts, and you'll use them for different things. But it would be the daily chart that would give you the close view at what the leverage ETF is doing as far as maybe coming back into a pullback to support and setting up for a potential entry, perhaps near a moving average line or a breakout from a moving average line. You could use the weekly chart for entries as well. But the weekly charts typically show the things like the MACD and TSI indicators a little bit delayed as far as their crosses on a chart. So they can work. It's just you may end up getting in a little bit later than you had hoped or would have been ideal, and perhaps getting out a little bit later than would be ideal as well. It's good to look at the underlying index that the leveraged ETF is based on. In the case of the TQQQ, that's the QQQQ, which is the NASDAQ 100. And the reason you would do that is sometimes you'll see subtle changes between the charts, subtle things that might help you with the day-to-day trading that might position you to be a little bit more profitable than if you don't check that out. There's a lot of different variations of doing swing trading, and because of that, it can be tough to measure from the standpoint of back testing. Here's an example of a swing trade. This is, I think, a fairly typical example in that we see a pullback on the chart here of the TQQQ coming down below the moving averages. The green line here is an 8-day simple moving average. The red line is a 50-day simple moving average. But in this particular case, we have a gap up in price above the 8-day simple moving average. And you'll see that there was a cross on the MACD, which is the next indicator below, roughly the same time. It actually happened about a day later, but you probably would have seen that it was about to happen on the breakout day. Down below that, there's another indicator called distance from moving average. And this can be adjusted depending on which moving average you want to look at. But if you wanted to measure the distance of the price from, let's say, the 50-day moving average, which is what we have this set for now, this is the way this stair step would look as your price gets further away from the 50-day moving average. The stair step moves up. So it gives you a quick indication of maybe how close you're getting to the max distance away from a moving average before you would experience a pullback in price. And as an example, that happened in this particular spot here. So it's a good tool to use, and it works, I think, even better on the weekly chart. Down below that is volume, and here, if you look at the breakout day, I drew an arrow down here. You can see how the volume was considerably higher than it has been recently and higher than average. So it's definitely a good high volume day for a breakout to get in on this trade. So you would enter here and you would follow the trade up, and with luck, the price will follow the moving average, and the moving average will act as a little bit of support for the price. And it did that to some extent here. The key here is that you could have looked at the 50-day moving average as your exit strategy. If the price breaks that, then defensively it would be a good time to exit the trade and get out. So it has done a good job following the 8-day moving average up to a nice high until over here where it gets to a point where it does come down and breaks through that 50-day moving average. Now, you wouldn't particularly get out at that point. You could use the low of the candle wick there as your stop loss point to get a confirmation that the price is really going to drop down below that. So you would set that as your stop loss and look for a subsequent candle to break that in the near future. And that's what we had here. A candle broke down below that low, and so that's when you would sell this, and that would be in a defensive type sell. Let's push this out to a little bit further in the future and look at what happens after that. Here we had sold the leveraged ETF, and it continued doing a pullback and got over here on the right side of this little cup formation. And you can see how it gaps up again. And we look down here and yeah, it's gapping up on some volume. And we do have a little bit of an entry confirmation with the MACD as well, with a crossover there. So this would be a good time to get in again, gapping up over this 8-day simple moving average. I made a note here on the chart. The MACD is a little bit tougher to look for entry and exit confirmations with crosses on a daily chart than it is a weekly chart, because you tend to have more of them closer together. So it's not quite as reliable, but you'll see what I mean when we look at the weekly chart here in a minute. In any case, this continued going up again, following the 8-day simple moving average, and we could use the same defensive sell type strategy with 50-day moving average. It's really good to think about what your sell strategy is going to be early on in the trade. Can you position it for an offensive sell, or do you have to go to a defensive sell, or can you use a combination of the two? And in this particular case, because of the way this moved up very quickly near the end here, it's almost like a climax type of move with multiple gap ups. You could have looked at that as an offensive sell signal to get out with these multiple gap ups. You could also look at where are you at as far as distance from the 10-day moving average, going down to that indicator below, and you can see how as we were moving up on that into that gap up area, we were getting pretty extended from the 10-week or 50-day moving average. So we could have exited with at least a partial position here, if not the entire position. But let's say it was a partial position and we decided to do the balance on a defensive sell. We could look for a break of the moving average or something like the largest down day in the move, which is what we have here. And you can use this as a defensive sell signal to get out of the trade. There's a lot of different ways of exiting and selling, and there's a lot of things you can study around this, but my point here is that it really helps to decide on what you're going to use ahead of time and try to be prepared for how a stock might move to propel you into doing that sell. Let's look at the weekly chart for a minute. Weekly, here is the same entry that we had on a weekly chart, and I have taken off the volume in this case and just show the distance from the moving average down below that indicator and the MACD above that. So we again would have entered here, which you would have seen much better on a daily chart than a weekly chart. If you look at where the actual cross is on the MACD, it doesn't happen until 2-3 weeks later. And you could have used this for an entry. It's just that you would have missed part of the move. And, we'd all like to have greater profitability. So it's something you could do, though. The price followed the 50-day moving average up until it broke over here, which is what we showed for that first sell on the daily. And we got a confirmation with another candle that broke the 50-day, and that's what got us out of the position. It pulled back here and moved back up again. And if you look down here, we can see that there is some confirmation for the exits on the MACD here with this cross and here with this cross. I'm sorry, this would have been the entry, and of course, and then this cross for the exit. And then another cross here for an entry. Follow it up again to new highs and look for either an offensive or defensive way to exit the position. Again, just plan ahead. Some of the observations I had about this strategy are that, first of all, you should always use a stop. You have to have some risk mitigation in there. But when you look at using a stop with leveraged ETFs, it's not quite as clear cut maybe as doing it with a stock. You might be using, let's say, a standard 8% stop loss on your stock positions. And let's say that you've got a standard position size of $10,000. That would be an $800 stop loss if you get shaken out. In the case of a leveraged ETF, where they tend to be more volatile, you may actually need to go with a higher stop loss for the trade to make sense. You might have to move your stop up to a 10, 12, 14% type stop for it to make sense in the trade. So the question is, how are you going to handle that? And one of the ways is to cut back or scale back on your position size. So instead of using a $10,000 position, maybe scale back to a $6,600 position, where if you have a 12% stop loss there, your hit to your equity is $792, just under that $800 hit that you have taken with an 8% stop loss. So it's very similar. It's just that you've got a little bit smaller position size. The good news, though, is that you have, again, this is a triple X leveraged ETF. So you've got a lot of leverage working for you to help offset scaling back on that size as well from a profit perspective. Determine your exit strategy early. That's one of the best ways of holding on to profit. Make sure that you anticipate and think ahead and watch what your leveraged ETF is doing and determine whether you're going to exit on weakness or strength. And using a profit-taking approach is good as well. If you use that, set a profit goal and exit if you hit it. And if you get back in, maybe go back to your original position size to get back in with and hang on to the rest as your profit. The advantages of doing this particular strategy is it's a fairly high probability strategy for capturing large moves and gains. And it's been used by a lot of traders. It's got a record of being reasonably successful with a lot of traders, so it's used a lot. Disadvantages are if you miss that initial low risk entry, then getting in later, it's not that getting in later is going to be a problem. It's just getting in later at a low risk entry position could be a little bit tougher. It's difficult to quantify the results comparatively with this because there are so many ways of doing it and there are so many variables, and doing back testing because of that can be tough for comparing to other strategies. The next is day trades. If we look at day trades, these are used a lot by day traders. In fact, if you're a day trader watching this, you're probably already using leveraged ETFs. If you're not, then this may be an example that you could look to as a strategy for doing day trades. But the thing is, they typically have very large moves, and it's not uncommon for 4, 6, 8% type moves in a day. And because of that, they can be very attractive for a day trader. A lot of times these are impacted by some kind of news or event, and it really helps to understand what's driving the move, what type of news or what type of event. Is it something that's going to die out in an hour or at the end of the day, or is likely to cause a move that could last over weeks? There's all kinds of things that will drive activity and action in these leveraged ETFs. There's a lot of different trading options, a lot of different ways of doing day trading. And in this example, I'm going to show one that's called a breakout opening range 5-minute candle high. And it's a relatively common way of doing a day trade. Try to plan your exit strategy in advance as best you can. It's good to enter your stop at the same time you enter your buy order. And you can potentially find short pullbacks if it moves up where you can do an add-on to your position, or certainly bring your stop loss up to that pullback area and raise it so you can make sure you capture at least part of the move for profitability. And the nice thing about this is you can go with the flow. And I mean that if the news is positive, you would look at the TQQQ. If the news is negative, you could focus on the inverse leverage ETF, the SQQQ. So there's several different ways you could approach this. This is a 5-minute chart, and this shows the early morning extended hours in a light brown color, the extended hours after the normal trading day in a light blue color on the right-hand side. The white is all the standard trading day. Here we have, these are all 5-minute candles. This is a 5-minute chart. So we have our first 5-minute candle that comes up, moves up, and we could use the high of that to set as a buy stop, and then look at using the low of that candle as a sell stop, and maybe add a dime onto each, each way. So in other words, the bottom of the candle plus a dime and the top of the candle plus a dime for your stops. But you could use that, and then the next day, or I'm sorry, the next 5 minutes, the candle wick does move up over the top of the first 5-minute candle. So you would enter with your buy stop and set your sell stop at the same time for the bottom of that prior candle and the dime. And follow it up. It looks like it's going to move up pretty well, and it's going to follow some support here. This is a 10 moving average, and it's going to follow that up a little bit for about 15-20 minutes, and then do a little bit of a pullback, forming a little bit of a flag position here, and then break out of the flag. So this would be a good place to do an add-on position. It would certainly be a good place to bring your stop from down here up to, let's say, the bottom of this candle here. This could also be your stop for this add-on position here too. And you would look at following that up and stay in the trade. And here you've got to decide what your exit strategy is going to be. Are you going to exit based on something like a break of support, like breaking the moving average, like you see it happening over here? Or are you going to use a stop? You could use the stop you set here at the bottom of this flag as your exit strategy. But you need to decide that as it's moving up, or as soon as you can in that move. And if you decided to exit at the break of the moving average, you could have used the bottom of this candle here as your stop, and then this next candle broke it, and that would have been your exit. If that was the case on this particular trade, you would have had a gain of about $1.08 per share. If you had instead used the bottom of the candle, the flag, for your stop, you would have stayed in the trade all day because it never went below that, and it went up a little bit higher, in fact, and exited in the last candle of the day, in which case you would have a gain of about $1.82 per share, which is pretty good for the day. A few observations. The advantages of doing this is that there are a lot of different ways of doing day trading, and the key is to know and understand the character of the leverage ETF and what is driving it, what kind of news or event is driving the move. Those two things can help position you to be more successful trading this. Uh, there's a lot of volatility with leverage ETFs, so the moves are generally pretty good for a day trade. And if you're lucky and it keeps moving, you may be positioned to do an add-on or to certainly move your stop up to, make sure that you capture a good portion of the profitability. Sometimes you'll find significant indicators, maybe like a 5-day VWAP is an example, that can be part of the trade where it shows good support for the price during the trade, in which case then that may help you actually stay in the trade a little bit longer than maybe you normally would have and capture a greater amount of profitability and gain. Some of the disadvantages are that you can get stopped out very quickly. Reversal can happen and you can get zapped in the next 5-10 minutes after you place your trade. You just never know. But you've got to be really quick with how you handle these. And that's why it's so important to make sure that you enter your exit strategy at the same time you do your buy. Because there are so many different ways of doing this, it's very difficult to backtest and compare it to buy and hold. The next one is that combination strategy that I mentioned. It's a little bit more complex than a standard swing trade. In this case, we were using two sets of criteria for the entry and a couple of different indicators to help us exit. But in the case of the entry, we're looking for bullish momentum that is going to be shown by the MACD crossover. And we're going to look for either bullish momentum with a stochastic indicator or a oversold condition on the RSI, a 3-day RSI, to help us understand that this is a good place to enter the trade. Exiting will be generated by an ADX and a MACD. In this case, we're looking for the ADX to cross below the signal, and we're looking for the ADX at the same time, the 21-day ADX, to be above 23, which would indicate a strong downtrend. So if you get those two conditions happening at the same time, that's where you would look to exit. Of course, you would also exit at a stop loss or a profit target. In this case, we're using a 21% profit target and a 16% trailing stop loss. This is what it would look like on a chart. This is a daily chart, and it's a little bit busy because we've got multiple indicators on it. We've got a MACD down here at the bottom and another MACD at the top. We've got an ADX indicator, we've got a RSI indicator, and a stochastics indicator. So this is where you would look at the entry, and when you get in, you would of course set your profit target and your trailing stop levels as part of that. But you have a positive crossover on the MACD, and you have a bullish stochastics here with the fast line being above the slow line. We do not have a 2-day RSI that's below 36, which was the third potential indicator to look at. But that's okay. We've got 2 out of the 3, and that's all we needed. We needed the first one, the MACD, and then we needed either or the stochastic or the RSI indicator to tell us that it's a good place to enter. So we would get in the trade and we would follow it up. And in this case, we hit our profit target and we'd sell. The strategy as I viewed it, I don't recall them talking about whether you would re-enter immediately or not. I think that a good way to handle this would be to exit and take your profit, put that to the side, and re-enter with your initial position size because it's still behaving well. It's still going up and still looking good. If you did that, you would be in it up to here where we have our exit conditions. And the exit conditions are based on down here below. You'd look at this ADX and this MACD, but we have a negative MACD crossover, and we have an ADX that is greater than 23. So that would tell us that this is when we would want to exit the trade. If we move this out a little bit further, we would see similar conditions after we exited. It pulls back quite a bit, but then starts going back up again. We would see similar conditions here with a positive MACD, a positive stochastics. The RSI does not come into play again, but that's okay. We've got one of the two and the MACD for our entry conditions, so we're good to go. We would enter, again, set our stop loss and our trailing stop loss and our profit target. In this case, I believe we hit our profit target. Again, you would want, in my opinion, to get out at this point, but I guess you could stay in. If you did stay in, you would get your exit criteria over here about 4 or 5 days later, where you would get your sell exit criteria with the crossover below and the MACD and the ADX, again, with a greater than 23 reading. So that's when you would exit. And you would have a new buy entry here, go through the same old thing. Again, that's why they call it swing trading, the up and downs. But it looks like a fairly decent strategy. I'm pretty impressed with it. And the advantages of this are that the swing strategy actually had a back test that was done on Wall Street IO that showed a 10-year performance with an average annual 63% return, which is pretty good. I know I'd be happy with that, and it outperformed buy and hold for a lot of those years. The average were about 9 trades a year, and it is kind of interesting the way it combines momentum and overbought, oversold indicators. The thought is that potentially gives you a higher level of accuracy. I'm not sure how true that is, but it sounds reasonable. The strategy includes risk management tools, and it's not that difficult to understand and implement. The key is really knowing what the exact parameters are before you move forward with this. And that's one of the disadvantages, but I'll get into that in a second. The the statement was made about not entering or not making a buy while any of the sell criteria are present, and that was possible, that could happen. So it's something to look out for. It definitely requires some active monitoring and uh, execution of the trades. Timing is not provided within with the way the strategy was presented, and it can be a little bit tough. It's like most of these strategies, not good at all during a choppy or high volatility market. And the exact parameters were for the stochastics weren't specified. I assume that they were default, but I don't know that for a fact. And there were two different parameters provided for one of the MACD indicators. So that threw me off a little bit too, and I had to guess. I think I did okay, but yeah, and it's a guess, so it could be different. And one of the things I found, I looked at Wall Street IO backtesting. They've got some good stuff there, but they don't show the individual trades. So in my mind, that makes it very difficult to validate the backtest itself. I would feel a lot better if I could see the individual trades that went along with the backtest. Okay, the last strategy we're going to look at is the one I'm most excited to talk to you about. It's the LETF Leveraged Edge Strategy. And this is one that I've been working on for a while now. And it's, I think, a lot different than some of the other strategies that you've seen. This is based on a custom program that has defined rules that are written around a number of different stochastics, several different stochastics that have been proven to perform well for about 8 different leveraged ETFs. The strategy only runs on the TradingView platform, but the settings are predefined for each of these symbols and are provided to you as part of getting the strategy. And those are given to you in the form of a spreadsheet along with backtest results that go with them, so you have an idea of their performance that go with it. They are achieved through a authorization process with TradingView. It's an invite-only type of strategy on TradingView. You have to be authorized to use it, and that's done through the leveragededge.com website, where you would pay a subscription fee to get the strategy, the spreadsheet, detailed rules, and training that would go with this. The nice thing is the settings can be modified, they can be changed, and sometimes that is very helpful to better reflect an individual trader's style and risk tolerance. And they can also be, tried and tested with a lot of other leverage ETFs, 2x ETFs, regular ETFs, perhaps even stocks, but there's a lot of instruments that have not been tested or tried with this particular tool, and I'd encourage you to check that out. An additional indicator can be added to the strategy, which we found can increase performance, reduce the drawdown, and reduce the number of trades. And it's available on either a weekly or a daily time frame. So the reason that is attractive is that daily generally involves a greater amount of trades, more monitoring, more in and out, but higher profitability than weekly, which would involve just buying and selling at the end of the week, other than stops, and a lesser number of trades, less monitoring required, and it is going to be a little bit less profitability than the daily typically. And I'll show you what that looks like in a few minutes. This is also referred to as just the edge strategy for brevity's sake because the name is a little bit long. This is what it looks like on TradingView. This is a chart that shows the candle prices on the top, the different signals that the strategy generated uh, as far as getting out, taking a profit, exiting, buying, etc. And you also see signals in the stochastic and the strategy itself down here that correspond with those. So in this case, we have a sell icon, we have a rebuy icon, and another sell icon and a buy icon that go with the strategy. The lines here tell you right away that this is on a weekly time frame. So all of these work on a daily chart. The strategy only works on a daily chart. But when we use the strategy, we can apply either a weekly or a daily stochastic to it. And the weekly stochastic looks like this with this stair-step type of look to it. Each one of these represents a 1 week period of time. The daily would be smooth lines. You wouldn't see these stair steps. And I mentioned earlier that we can add an extra indicator to the strategy. In this case, a MACD indicator has been added to this to help boost the profitability and reduce the number of trades, and it can be very helpful. So we're going to look at some backtesting now. The next couple of slides will cover backtesting for multiple time periods and give you a sense of the performance that the strategy has. It's important to remember that backtesting is a tool to try to give you a sense of how the strategy might compare to buy and hold or other strategies. It's not going to give you a good sense of how the strategy is going to perform for you in the future. You don't know what's going to happen in the future. There's just no telling. Certainly, the strategy is not going to give you these kind of returns when you use it, most likely. And a lot of that's because the strategy is automated and you're going to be doing things manually. Part of that is trying to capture trades near the end of the day. The strategy takes the last closing trade of the day for buying and exiting positions, and that's difficult to do. So chances of you being able to match that is pretty slim. So there are going to be differences in the strategy buy amounts and sell amounts comparatively to yours, and you just aren't going to do as well as the strategy backtest. You need to understand that up front. But that said, the backtest does prove out and provides a lot of substantiating evidence that it does well compared to buy and hold and does well compared to other strategies. So here we're looking at, on the left in the purple, is almost 6-year period, on the right in blue, an almost 11-year period. The 6-year period takes us through the end of the third quarter of this year and shows for 3 different leveraged ETFs on the left how buy and hold did for that time period compared to the strategy to the right of that, and how the strategy performed over the same period of time. Same thing is true for the 11-year period in blue, where we show the buy and hold on the left-hand side of that and the strategy performance on the right. We can't show a total for FNGU because that began trading in January of 2018, so there just hasn't been enough time yet. The calendar year or the 11-year back test is for calendar years that took us through the last ending calendar year of 2023. The other back test I want to show you is if we took those individual back test years and pretended we were going to buy into the strategy or use the strategy to make or to help us with our buy and sell decisions for any particular year. Let's say that we consider 2019. We'd look at the strategy's first potential buy for that year as a potential entry point, and then we would get out at the very end of the year where the strategy completed its last trade of the year, or if it extended out a little bit into the first trading week of the following year, but certainly no later than that. In that case, the strategy for the daily version of the stochastic would have had 13 trades for that year, a max drawdown at 14.5%, and a return of 90.6% compared to buy and hold of 84.7%, and buy and hold drawdown of 32%. So even though the strategy is beating buy and hold just by a few percentage points, that's significant by itself. But if we add on to that the fact that it is, giving you a max drawdown that is less than half of what you would see in buy and hold, is pretty impressive. The top portion of this is using the daily version of the stochastic. The bottom portion is using the weekly version of the stochastic. They trade differently. In the daily, you could potentially have buys and sells any day of the week, where the weekly version you would be buying and selling on the last trading day of the week. So there's less trades involved on the weekly version. There's less monitoring required. It's a little bit calmer approach to trading the leveraged ETF than trying to use a daily version of the stochastic. The daily version sometimes will give you higher performance and less trades. The weekly, sometimes a little bit less performance and fewer trades. But over this particular time period, this almost 6-year time period, the weekly did very good and actually ended up on average beating the daily version. The weekly averaged out with a 92% return, where the daily had an 86.6% return. The average number of trades were 27 for the daily versus about 5 for the weekly. That's the average per year. So you can see that the weekly trades are a lot less than the daily. The advantage of this is that it works with multiple leveraged ETFs, and most of the strategies that I've seen out there will focus on one or maybe two leveraged ETFs, and that's typically as far as they go. This works with multiple ones that we know have good results. The settings are adjusted to maximize profit potential, and they're provided to you as part of getting the strategy. And you can adjust these to fit your particular trading style and your risk tolerance. We encourage you to set alerts for the strategy. They work well, but we also encourage you to get to know the rules well so you can anticipate things before they happen. That's going to position you a lot better for being successful with the strategy. And it's not always good to rely on alerts. Things can happen, and you may not get an alert when you were hoping to get one. That kind of thing has happened. I've seen that happen no matter what the strategy. And the backtest results and details are available for you to look at, to reproduce, to verify, etc. at the website. There's video tutorials available on the website for training, and this is a custom strategy tool that works on TradingView, which is a platform used by millions of traders across the world. Very popular platform. If you're not familiar with it, maybe it's a good thing to check out. We did run through a beta test period. This has been in the works now for several years. And this past year, we've had a group of a little bit under 100 users that were authorized to use the strategy and give us feedback on it. And we've gotten a lot of good feedback from them. So it's been working for a while, and it's not a brand new type of strategy thing that we're introducing to you here. So those are the advantages. The disadvantages are that, if you're not already using TradingView, that might be a huge disadvantage because there obviously is going to be an additional learning curve and additional cost if you move over to TradingView. TradingView charges for their program, for their platform. It's not very expensive. You can go with the lowest cost version, the Essential. You don't need a version that's higher than that. But it really depends on what you want to do with TradingView and with the strategy and how many different strategies you want to, or how many different symbols you monitor with the strategy. The strategy, its weakness is probably choppy markets. That's the biggest, weakest area for this strategy, and probably for most strategies out there is choppy markets. So you have to exercise extra caution during a choppy or volatile market. And we try to offer some ways to mitigate that in the training that we do at the website with some tactical sell rules to help you through that if you are trying to stay in during those periods. The strategy, even though it comes with detailed rules and defined settings and training and authorization, etc., all of that is only available through a website, and you need to pay a subscription fee. So you can consider that a disadvantage too. And of course, there's the level of risk in trading leveraged ETFs that goes with this. So that's something that's could be considered a disadvantage too. We'll do a wrap up now, but we've looked at a number of different strategies. We've looked at buy and hold. We've looked at day trading and a couple of versions of swing trading and the LETF Leveraged Edge strategy. Now, you need to decide if any of these are of real interest to you. And if they are, I'd recommend you do some research. Check out the original video that was done on YouTube to take a more in-depth look at the strategy and try to figure out if it's something that you want to get involved with, that you want to pursue, that you want to try, or that you want to use. As you do that, ask yourself some questions about, as part of the process. Is the strategy well defined? Does it have clear rules? Does the strategy offer effective ways to mitigate risk and take profit? Can you implement it and follow it? I saw a number of strategies in YouTube videos that are very complex, and I just don't think there's any way I could follow it, at least not without doing an automated type process. what evidence is there on how will the strategy perform? And that unfortunately is not provided with a lot of the strategies that I saw on. Does the strategy provide any kind of training or support? Does it need to have any kind of training or support? And if so, is that available? Uh, but in any case, those are some of the things to think about, to ask yourself as you go through this process, and focus on one of these and try to become good at it. Try to practice with it and develop it, and hopefully it'll set you on a path toward mastering leveraged ETF trading. If you are interested in the LETF Leveraged Edge strategy, please check out the other video on my channel that introduces the strategy in more detail. You can also see that at the website leverageedge.com and learn more about the strategy there. Of course, you can sign up for a trial or do a subscription, whatever you want to do. And here are the links for the different videos that I watched that I took some of this information from and that you should go to and check out as part of this process. Thank you very much for attending. Thank you very much for sitting through this video. I appreciate it, your time. Bye now.